Hello, everybody, and welcome to this new video in a three-part series where I want to talk about the main assets that I consider essential in investing. And today's asset that I want to talk about is buying a good home with leverage. And I want to talk about why this is such a good investment. Because you see a lot of debate about people saying, "Oh, is renting better than buying?" Scaring people from buying a home. Again, this is just entertainment. This is not investment advice. These are only my opinions. But this is what I believe, and I think it's important to share it with the channel. So now that I've put that out of the way, let me tell you why I think buying a home is one of the best ways to beat the denominator, and it's actually one of the ways that most people use, most middle class families use without perhaps even knowing it. But that's what they do. It can beat the denominator. So first of all, let me say that I make this argument mostly for single family homes. Because even though apartments, for example, they may be convenient, um, when you're younger, etc. And yeah, I guess in some cities in Europe, you can make the case that apartments are a good investment. But in the U.S. in general, no, you don't want to look too much at apartments. The typical U.S. home that appreciates as kind of these characteristics, or at least that is my experience, what I've seen. What is it? Well, first of all, it has to be a single family home, preferably detached, with a nice lot, front and backyard, and at least a 3-bed, 2-bath, or a 4-bed, 2.5-bath, or a 5-bed, 3-bath. But your typical home that can accommodate the typical size family. Um, and you may say, "Oh, well, I don't need that much space." Well, even if you don't need that space, it's not about us buyers. It's about the investment. It needs to have that space. Homes that are like very very tiny typically don't sell very well. Then you need to have a good neighborhood. So a good neighborhood means what? It means a neighborhood that has a safe area, right, where you can walk in the evening without being concerned, and it needs to have a good school district. Even if you don't care about safety, and even if you don't have kids, again, it's about the investment. You can't move that investment. That investment is going to stay there forever, and most people are going to care about safety and schools. And so you need to care too when you go buy that. And then it has to be in a stable or growing city. And I have to say that because there are some cities which, unfortunately, has seen a lot of decline. I can think of Detroit, for example, where there's been a lot of decline. And so, if you want to live in an area that has had a lot of decline, then it's important to seek out the suburb, or that one town in that area where all of the people that like the area, that live there, go and move, essentially. Like find the one. There's always an enclave that is going to be very very high end, even in declining cities. So that's where I would look at, or ideally you would go in a growing city. And what's growing really fast in the U.S. Right now? Well, most of the South is growing very fast. California is still growing. There's so many areas that are growing so fast in the U.S. Where one can think about moving and living. And of course, the east of the U.S. is still extremely strong, extremely strong. All of the east. Anyways, moving on. So, why are single-family homes such a good investment? Why are they such a good investment? Well, first of all, people always need them. For millennia, we've always lived in homes. That's not going to change tomorrow. It's a matter of need. Just because there's a recession for a few years doesn't mean people are not going to need homes. People always need homes. So that's a big, big part of this thesis, right? You can't say that of all of the stocks that you buy, or you can't say that about a lot of the assets you buy, but you can definitely say that about all homes. People always need homes. It's the biggest expense of most families, traditional families, and therefore what that means is that you always qualify when you want to sell a home. You always qualify for, say, 30 to 50% of a couple's working hours, how much money they're going to make for the next 30 years, which is typically the mortgage that they get. That's kind of that's one of the factors about how homes are valued, and why they can be really expensive. Again, people are willing to put a lot of money into homes because they're so important to us and to our lives, and people know that they're a good investment too. Um, But why are homes good investments as well is because they are hard to build. It's not, this is not like a TV dinner. This is not like an industrial product where you just crank the factory a little faster and there's more, I don't know, frozen meals coming out. This is not like that. Building a home is very, very hard. You have all of these regulations, all of these permits, and then even if you jump through all of these hoops, then it takes 6 to 9 months to build one. You have to have 20 plus trades come to your construction site to build that home, and those trades have to be available. And per my research before making this video, it's about 3,000 hours to build a 2,000 square foot home. So that's even smaller than the average home. 3,000 hours, so really $3,000 to $4,000, depending on how big a home you get. That's a lot of money. Like, what is 3,000 hours worth of labor going to be worth 20 or 30 years from now? Like, right now, it's pretty close to $100,000 for 3,000 hours of labor, because laborers in the construction world are getting paid quite a bit. This is the construction pays, 80, $90,000 a year. Construction is not, I mean, not entry level, but a skilled tradesperson costs a lot, and it's a real job. Like, who wants to do drywall all day for 9 hours? Who wants to be on the roof all day and do roofing? And I would argue these jobs are going to make more and more money as you go forward. And so if you buy a house that's already built, it's a way to look at, you're buying savings of labor. Like, you're buying man hours that have already been spent building that house. So again, very important point here. Then materials and land, they're both hard assets. Commodities like copper or lumber, you can't just print it, right? You need to have a well-managed forest, or you need to have a mine. It's an asset with a cap, with a limit, and so is land. So not only are they hard to build, which makes them hard by nature, but they're also made out of hard assets. And there's a lot of future opportunities for monetization of these homes. Like, this is something that we don't realize today as much, but as solar panels get much better, it's very, very likely, or at least is my vision, that in a few years, solar panels will not only power your home, but they will also power your car. So you'll be making energy out of your home, and you can resell that energy to the grid, and you can also always use your home as a way to earn money, for example, with Airbnb. And lastly, homes are a way to freeze your housing costs in time, because you're going to be leveraging. So borrowing most of that money, you're still paying the price that you may have paid 30 years ago. If you're in your last year of payments, you're still paying that home that used to cost $70,000. You're still paying it 30 years later in 2022 when you bought it in 1992. And so you freeze your housing costs in time. And so as you see other people who decided to stick to renting have their costs go up every year from landlords, you don't have that. You only have your costs go up from the standpoint of insurance and perhaps property tax, but you don't have that from the standpoint of your actual payment. Your payment stays stuck in time, or is frozen in time, which is one of the big deals. Over time, it will save you money. Like, it's not going to be obvious within the first 10 years you buy a house, but after 10 years of owning a house, it will become pretty obvious. So what are the downsides? And there's a lot of naysayers that are against single family homes. I mean, that's a theme around investing. You can always find people to convince you to not invest in anything. But they are very real downsides for real estate, for owning a home. The first one is property taxes. Property taxes right now, depending on where you live, they're 1 to 2% of the value of your home. But I mean, we have to be honest here. It's very likely that property taxes are going to go up, right? I've never heard of a school district who was like, okay, let's lower taxes. No, it's very likely that within the next 10, 20 years, as administrations, local administrations become bigger, it's very likely that they levy bigger taxes, and so you may have property taxes that end up in the 3%. But that's okay, because we're going to see the advantages of borrowing money. That's okay. The property taxes are like the main cost. Home insurance is definitely a cost of owning a house. Although if you do high deductible, very high deductible is going to be very reasonable. And if you have a stock portfolio, it's very easy for most to decide to go with high deductible. And this also fits with home insurance repairs, right? So a lot of people, oh, maintenance and repairs, right? That costs a lot of money. But I'll just read this is to me, frankly, this is not a factor. Like this is a non-factor because if you do the work yourself, most of those repairs you can do yourself. And although it used to be that being in the trades, doing drywall, doing plumbing, if you go back 15 years ago, yeah, that was perhaps a little scary. But today, I mean, there's so many resources on YouTube. Um, I've owned a few houses, and it's like I've become Andy. You learn. I mean, you really, really learn. I mean, you learn like changing a faucet. That's real easy. That's not hard. Doing a little drywall because you need to do that. That's not hard at all. You can learn much of the stuff that you need to do to fix your home, and sometimes they're very, very fun projects for the weekend. So I would say that repairs are not as much of a factor. And if you have a high deductible insurance, you wouldn't be using your insurance for tiny repairs. You would only be using it for like very big repairs. So there's ways to minimize both of those. The big red flag, of course, is property taxes, where it's very tough to minimize. I would argue that if I were to choose a state, I would want to be wise as to which state I choose. And so there are states that are pretty decent on property taxes. New Mexico comes to mind, Florida a little bit, but New Mexico especially is like very low on property taxes. So make sure you do your research depending where you live. The property taxes can be pretty high, and they're the biggest downside in my opinion. And other people say, oh, well, what if I need to move? What if I need to move? I'm not certain I want to live here. You see a lot of people is like, oh, I don't want to buy a house on my own. I want to get married before I buy a house. That's like another thing people throw at you and tell you. I don't want to settle until I'm certain. Well, you're going to be leaving a lot of money on the table. Like if you don't buy a house as soon as you're able to buy a house, and you say wait 10 years from now until you have some idea of what life you want to buy a house, yeah, real estate prices will have shot up quite a bit. So again, my argument here is that buying a house is perhaps the earliest move that an investor should make in their journey, is to buy a house. That should be perhaps one of your first moves. Because of many advantages that I'll outline now. But one of them is leverage. But another one is this advantage, which you may know this. A lot of people know this. But in the U.S., you have the right to $250,000 every 2 years of tax-free gains on your home. So what a lot of people do is they'll buy whatever house they can afford. They'll buy maybe a fixer-upper house, and they live in it 2 years, and they fix it up for 2 years. And then when the 2 years are up, your house, you fix it up so it's increased in value, and you sell it, and then you go to the new house and you fix it up again, and then you sell it, and then you go to the new house, fix it up again, and you sell it. And if you do that about 4 or 5 times, you should get into $1 million house. You should get into a dream multi-million-dollar house. Not multi, but maybe a million. Yeah, yeah. It's feasible. It's imaginable to do that. To upgrade up, buy a house, make it nice, fix it up, do all of the stuff that people don't want to do when they're in a hurry. Like paint, for example. Like this, like painting a home is very, very easy, and it's one of the big ways that you can make a nice return. So anyway, you can do that, and nothing prevents you from upgrading or swapping up as you go through time. So it could even be a big plus, right? So that's why I would push back against the idea of no, I don't want to move until I get the right person to be moving with, or the right thing to do. No. I would say even if you're early on, like if you can buy a house, you should probably buy a house. And what do other people say? Oh, you need to move. So okay, so let's say you don't want to do the sell and resell. I would argue that if you have a good interest rate, and say we are in a rate environment where rates are markedly different from what they were when you bought the house 2 years ago or 1 year ago. Like right now, when I record this video, this is the case. Like mortgage rates have doubled. It's not supposed to happen that fast, but it did. If you move, you may be reluctant to sell your house because you would be getting into a higher interest rate, right? And you'd lose the mortgage. And so in that situation, in the whole need to move situation, I would recommend, if you can afford it, buy the new house and keep the whole house. So buy the new house without selling the old house. It may make sense for you to keep the whole house, um, and mortgage associated with that house. It is going to be a good mortgage because mortgages are associated with the house, and keep it as a second home. Over a very long term, over your investing journey, that may make a huge difference to just have two homes. And a lot of people are scared about having two homes, but really, I mean, if you have a regular landscaper that comes to the house, that's more than okay. Like if you live, say, less than 5 hours a day, you can do a road trip and go there every other month. It's okay to have a second home. It's actually really good from the standpoint of asset planning. And a great option if you want to have a second home, keep your old home as a second home, for example, is to use Airbnb. So Airbnb can be a great option if you want to alternate your second home as, say, an occasional rental, short-term rental, and also for your personal use. There's lots of uses for a second home. Like you don't have to sell that second home. And I think that's one of the mistakes that a lot of people do is when they move out, they rush to sell. And I think over the long term, if you have a mortgage on that house, it may not be a good idea because these mortgages are so low, and they're a great way to short the US dollar, which is what I'll say in the next video. A word of warning, and because this is what a lot of people do too, is they'll just buy a house, live 2 years in it, and then or 1 year or whatever. And once they move to a new house, they'll say, "Oh, I'll turn it into a long-term single-family rental." And I would be very, very careful with that because it's a different business and it's a different risk profile than just having a second home where you don't have a contractual obligation with someone. If you just own a second home and use it as a second home, you don't have a contractual obligation. If you actually rent it, if you rent a single family house that used to be your house, someone else, well, 2020 for me was a wake up call because I used to think it was a good idea, and then eviction bans can happen at any time, and eviction bans took literally forever to be lifted in 2020 and 2021. And actually, I can think of a few spots where it's still very, very tough to get any evictions going. So the thesis for a single family rental would be that you only would do it if it was easy to actually raise money from your tenants. And I think there's been a paradigm shift in this. It's not as easy as it used to be. And you have all movements. For example, you see it on social media all the time. Cancel rents. We're not gonna pay rent, etc. So be very careful with that because even though your tenant may not be paying you, because there's an eviction ban that happens, and eviction bans can happen for any reason, right? One of the common one is winter. Yeah, you have a bad winter. Another one is economic hardship. They can happen to any reason. Well, you can lose control of your investment because while the tenant, of course, does not pay rent, if there is an eviction ban, tenants know that. They're like, why would I pay rent? There's an eviction ban. I can't get evicted. You still have to pay for liabilities. You still have to pay for everything. You still have to pay for water bill. You still have to pay for insurance, etc., etc. So you could be in like in a really nightmare situation. So that's why Airbnb is a great option. And I think a lot of investors who have second homes, they either look at just having it as a second home for friends, family, personal enjoyment, store extra furniture, just keep it as a second home and wait 30 years to realize your return. You kind of keep it as you would like a gold bullion. That's essentially what it is, rather than rent it, because single family rental, and again, I know I go against the trend. There's a huge YouTube scene that is very pro single family rental, but I would be very careful with those. I would be very careful. Not investment advice ever. Okay, but let's get into the reason why. Why are single family homes good investment? What is the chief reason? And by the way, if this didn't exist, I wouldn't put it in my top three at all if leverage didn't exist. Like if you tell me I'm gonna buy a single family house and pay cash for it, I mean it doesn't even break my top 20 of the best assets to buy. The only reason why it really gets so high in these best asset to buy ranking, my three key asset classes, is because, and I'm going to unpack this sentence, but here's the sentence. They are the only hard asset, and I'm going to define what that means. They are the only hard asset that you can buy with a 33-to-1 leverage and with no mark-to-market risk. And mark-to-market risk is when you get wiped out, right? If you go on leverage and you buy stocks on leverage and you have a really bad day in the market, you can get wiped out. That does not happen with real estate. So this is a big deal. This is a very, very big deal. So let me unpack that. Single-family homes are a hard asset. There's only 83 million single-family homes in America. And think about how many are available at any point in time, because pricing happens at the margin. People who have very low mortgages are not going to buy. Retirees who have been living in their homes for decades and now are happy and retired and aging in place, they're not going to sell those homes. They're going to keep those homes. I was speaking 30 seconds ago about evictions. If you have tenants that just stay in the homes and don't pay rent and can't get evicted, those homes are not going to hit the market. So there's only 83 million single family homes in America. Only a portion of it hit the market at any point in time. So really trading happens at the edge here. But perhaps even more important than the edge at which trading of these homes happens, we don't build a lot of them. We really don't build a lot of homes in America. That's why they call it a housing crisis. That's why for, I think, the past 30 years, people have been talking about building more homes and housing affordability. We just can't build homes fast enough. So in times of boom, like in good times, like 2019, 2020, America is able to build about 1 million homes a year in times of boom. And by the way, housing units and homes are different. I'm talking solely about single family homes. To me, an apartment is not a substitute for a home because I'm talking about a good investment here. So you can only be about a million a year, but it's punctuated by huge times of bust, in which we are right now. Like where I'm located in Texas, like it's absolutely insane. Like it all came to a halt. Like that's it. Builders are not building homes anymore. And you go a year ago, it was absolutely insane. You had entire neighborhoods, entire rows and rows and rows and rows of houses getting built. Like if there's huge times of booms, mostly boom most of the time, and then you have big times of bust. So my estimate is that you really only get 1% growth a year in single family homes. So you only get diluted 1%. Dollar growth, and I've told that in so many of my videos. I've made multiple videos on this. I'll put one in the description. Dollar growth, about 15% more dollars each year are printed because the dollar is soft. As Jay Powell say, we print it digitally. He said that on 60 Minutes. So about 2 years ago, it said that on 60 Minutes during the events of 2020. So again, there is no limit to how many dollars there are out there. But there is a very hard cap on how many homes there are out there, and we can only build about 1% more. That's it. That's it. So, and that's with like a really good economy and really great businesses. All of the might of U.S. economy can only do 1% more. So that's point number one. It's an hard asset for all these reasons. Point number two, this is insane. 33-to-1 leverage. Like, I don't even think the wildest crypto platforms at 33-to-1. I think they had 20-to-1. Like this is 33-to-1. And what is that? That's a 3% down mortgage, right? First-time home buyers pay as low as 3%. If you're buying home for a first time, you can get a 3% loan. If it's the second time, you can get a 5% loan, which would be a 20-to-1 leverage, which is still pretty insane. So in a nutshell, mortgages are the way for the middle class to access the money printer, because obviously loans create deposits and not vice versa. This is not money that you're borrowing from someone's savings account. No, no, no. Loans, it's commercial lending. That's how it works. Loans create deposit, and so that's the reason why you can borrow with so much leverage. You have fresh money that is injected into the economy by commercial banks through two ways. They could issue the loan and keep it on their books, or they could issue those loans, repackage them in mortgage-backed securities, and guess who is the top buyer of mortgage-backed securities? The top buyer of mortgage-backed securities is the Fed, as well as government entities. So again, these mortgages are bought by the government. It is monetary printing. That is what it is. Um, so you access the money printer. That is essentially how it works. That is how the middle class can access a money printer, thanks to leverage on their single family homes. Which is why, not investment advice, but that's the main reason why it's such a good investment. Um, Imagine that. Compare that to the usual leverage you can get on stocks. Like stocks margin, it's typically 1-to-1. You can typically only finance 50% of a new purchase, right? So the leverage on single family homes is absolutely insane. It is just insane, and that's a big deal. And let me finish with the icing on the cake, which is the zero mark to market. You have no mark to market risk. So when you buy, let's compare. If you buy stocks with leverage and the value of your stocks go down, right? You get a margin call. You're gonna get a margin call. Or if you don't respond to the margin call, the bank is gonna sell your stock for you. But guess what happens in real estate? And you bet. I mean, if you buy a home with only um, we've only 3% equity with 90% of debt. If you buy a home with 90%, 97% of debt, it's very easy to imagine a drop of 5% in the market, but you're underwater. But the bank won't call the loan. It's not mark to market. The loan is not going to be called. So there is a very limited risk of being wiped out. You're not going to get wiped out in real estate. It only happens like you lose your house only if you stop the payments, typically, right? So that's a big change. That's the beauty of not having mark-to-market loans. I mean the way I look at mortgages is they are essentially government subsidies. That's essentially what they are. They are subsidies to the middle class. You can't borrow 33-to-1 to go buy Tesla stock. You can't do that. Absolutely can't. But you can do it with a house. So again, pretty big deal here. Um, and again, borrowing money in a period of monetary inflation is akin to shorting the US dollar. It is exactly the same as shorting the US dollar. That's what you're doing in effect. Let's use the Case-Shiller data. And let's imagine you are doing an interest loan only for the sake of simplicity. These exist, by the way. You can do an interest only loan. It's just that most people don't. Most people do a conventional loan. But for the sake of simplicity, let's imagine this example where you do an interest only. So you buy the house. These are real numbers, by the way. You buy the house in 1992, and you give up $76,000 in future earnings in the form of a loan. So you sell dollars that you don't have. You sell dollars in exchange for a average single family home. So you've borrowed money. So you've made a promise to give 76,000 back in exchange for a single family home. And you sell the house in 2022, 30 years later, the average length of a mortgage in America, the normal length of a mortgage in America. And in 2022, you buy back the 76K that you borrowed, and you repay the loan. But how much does it cost you to repay that loan in 2022? Well, it only costs you 25% of a single family home to repay that loan. That's all it costs you. So you've essentially made a 3x return on borrowed money, which is the beauty of buying a home with leverage. And of course, it's not entirely free, because you have all of these things that I haven't included because of the sake of simplicity argument here. But you have interest expense, but interest in no way amounts to the 3x of value that your home has gone for. No way. So interest expense, you have that, but its interest is artificially low. You have insurance, and insurance is just a matter of, I believe, you having a high deductible can do it. And then you have tax and maintenance. But this in no way catches up to the money that you make on the house. In no way. And, one may say, oh, well, actually, well, it does, and you can always find idiosyncratic example where you find that it does. Um, and what I respond to that is the argument is that you have to live somewhere. I mean, I'm assuming we're not going to live in the tent on the street. You have to live somewhere. And so if you agree to the assumption that you have to live somewhere, then interest, insurance, tax, and maintenance, I would argue in most cases, is going to be cheaper than what rent would be. And thus, you are still making that return if you take into account the fact that you would have been paying that in rent anyways. And to understand, really, to drive the point home, I'll finish with my favorite example that I always use, as to why real estate going up is a matter of the currency and is a matter of shorting the currency through debt, and not a matter of the virtues of the asset. It's not about the virtues of the asset. It's about, you just have an asset that has limited supply and that is desirable and that has limited supply, against another asset, the currency, that has unlimited supply. As Chair Jay Powell says, we printed it. Oh, we printed it digitally on 60 minutes, right? This is the example. One of my favorite examples. There's entire books where you can look at these homes. I love these. I could also make the case that these homes were better quality than the homes built today. Good materials make good houses. A nice, humble, Victoria style house, $725. That was the cost in 1908. And by the way, I looked up labor. Labor for a house like this back then would have been about $300. Labor and the lot, both. So really, about $1,000 you could get that house all in 1908. And today, today it's not even funny. I mean, it's not $1,000 that gets you. I mean, that gets you nothing. Like, that doesn't even make a dent in the real estate commission that you're paying. So, anyways, it's a complete joke, and that was 112 years ago. 114 years ago. But that corroborates what Charlie Munger says, which is he's the acolyte of Warren Buffett, Warren Buffett's right-hand man. And that's what he said recently, right? Last year, almost any currency will be worth less within 100 years. That is why you buy real estate. That is why mortgages are the best way to short the currency, because imagine if you could have borrowed $725 in 1908 and you were paying it back today and you still had that house. That would be insane, right? Because a house like this today is what, 200, 250, depending on where you live, right? So anyways, insane investment returns over the long run. Over the long run, the currency is going to zero. Therefore, you should borrow it. You should borrow it. Not investment advice. This was not advice, even though I said should. It's not advice. It's entertainment. So I hope you were entertained and edutained. And thank you so much for watching. No investment advice. Please like, please subscribe to my video if you can. I really appreciate it. And you can follow me at BeatTheDenominator on Twitter. Thank you so much, and have a great day.